Hey everyone, and welcome to today's show on Wealth Strategy Secrets. Today's guest is Rob Overstreet. Rob is the co-founder of Harbor Drive Holdings, LLC. Rob is a legacy cash flow specialist, capital raiser, syndicator, and real estate investor. Rob's passion is teaching investors about alternative investment opportunities. His goal is to help investors reach early retirement while building their wealth by applying the strategies used by the wealthiest 1% of Americans. Rob lives with his wife and two young children in San Diego, California. Rob, welcome to the show.
Thanks, Dave. Excited to be here. Big fan of yours, big fan of the show. And it's a real honor. I've been listening to many of your episodes for some time, and I've got some big shoes to fill.
No, grateful you're on the show, Rob. I think you're going to add a lot of value. I think the listeners are going to love it. So maybe we can just jump right in and talk a little bit about your journey, your background, kind of what got you into, real estate investing, alternative investing, and, what were your thoughts that you can share?
Yeah, thanks. I'm from Southern California. I grew up east of San Diego in a community called Imperial Valley, very rural, desert landscape, lots of agriculture. So, hard work as a kid was kind of a birthright, working on farms, driving tractors, all of that stuff. So fast forward, I go to school at San Diego State. I study economics. And I was working in hospitality business for some time, Ruth's Chris Steakhouse, where, and even after college. And that's when I tell people I got my PhD in hospitality and treating people right and communication, right? Yeah. And there were opportunities for me to advance with the company. And sometime during my tenure, Ruth's Chris went public. And so, they were sending me on assignments because they went IPO. They were opening new stores across the country like wildfire, and they would send me for weeks at a time to go help indoctrinate these new places and helping them expand, et cetera. But at some point I realized that, unless in the future it was going to be called Rob's Chris Steakhouse, then I didn't really want to continue down that path. And so started looking at other opportunities. I was a business owner of a few different businesses, and then really started educating myself on alternative investments and specifically real estate. And started taking baby steps, starting reading books, educating myself, seeking mentors, and underwriting deals, started making offers on deals. And we finally got to our first completed syndicated deal in Dallas, Texas in 2016. It was an 80 unit. And, we learned so much about the entire process. There's only so much you can learn in a book or listening to podcasts. I mean, at some point you've got to take action, and that's what we did. So I've been in the business. It even predates that first deal, probably 7-8 years now. And the last 5 of those have been full-time. This is my exclusive effort. So today we have about 1,700 units under management across multiple syndications. We raise capital and really try to educate our investors on the benefits of our product offering.
Yeah, that's awesome, Rob. So how did you jump really right into, getting into multifamily? A lot of people in the space of real estate investing kind of start with, single family rentals or Airbnb, things of that nature.
Yeah, great question. Some of my early mentors were telling me, the sooner you go big, the better. And so call it dumb, blind ambition. They said, oh, okay. Go big. So the very first real estate deal we did was an 80-door apartment. The next one several months later was a 120 unit, 132 unit door after that, and all within about a 18-month period, all syndicated deals. We have, investors in those. And to date, I've still never flipped a house, and at some point, maybe I'd like to check that off the box, but we just went for it, but it didn't start that way. I educated myself. Like I said, I read every book I could get my hands on. And for several years, I think in my gut, I was too nervous to take the plunge, to take action, right? Even though I'd listened to every tape, I'd had my heroes in the space that I would listen to religiously, read every book. I felt like I knew everything top to bottom about, syndicating apartment real estate deal, and just never took action until one day I just, looked myself in the mirror, said, you're either going to do this or you're not. And so that's when it all started, that deal in Dallas in 2016.
Yeah, that's excellent. I think a lot of people who jump into the active space on the real estate side, they probably don't have too much equity right? So they kind of start and work their way up the ladder, but you completely leapfrogged all that.
Did it in reverse order.
Yeah, that's excellent. So you must have a lot of experience in terms of, things like underwriting, right? Large apartments and everything. Can you tell us, what have you really learned about underwriting?
Yeah, that's a great question. That's if I could give any advice to somebody that's trying to get started as an active investor in the business, and even passive investors, should have a basic understanding of underwriting deals. Over the last several years since we got started, I've probably underwritten a couple thousand apartment deals, and over time you learn things, you start to develop, your own business thesis, and it really helps you gain that foundational knowledge to the point where today I don't even have to see pictures of an apartment deal. If somebody sends me a financial statement and a rent roll, I can tell you in about 5 minutes if it's a good deal or not without even seeing it. Now, we wouldn't submit an offer on a deal without looking at it first, but underwriting is so key, and it takes time, it takes repetition and practice. And you got to look at a variety of different models to see what fits you best. But I see some guys getting started in the business, go out and do other aspects of the business and provide value in other ways, and that's fine. But somebody on the team needs to have a strong foundational underwriting knowledge, or people could get hurt financially. I've looked at a lot of deals. I've looked at a lot of deals that other sponsors have brought out to the field, and the first thing I ask is, I want to see your underwriting. And I think to a lot of retail or passive investors, they're busy folks. They are entrepreneurs running their own businesses. They're, high net worth, high income, doctors, lawyers working 100 hours, and they just don't have the time to gain that knowledge base. And so, if you don't know certain things about what to look for and what to look out for in an underwrite, limited partners may not even realize that there's undercurrents of risk that may change their opinion about a deal before writing the check.
Yeah. Yeah, for sure. Yeah, we're always having that conversation that really, this real estate, investing in real estate is really a team sport, right? And not everyone can be great at what they do. But when you're able to work on the larger side, like say in multifamily, like you are, there's professional people like Rob, right? Who really understand underwriting and know how to look for those things that you wouldn't uncover if you were, say, a smaller operator, right? And then you have someone who's doing, the same thing on the acquisition side. They've been in the industry a long time. They have relationships with brokers. They're able to uncover those off-market deals and things. You have someone who's strong on the asset management side. So these are really critical components, right, that make up an overall team, to, I think, really ensure that your investment is going to be maintained, right, over the long haul. Since we have a lot of limited investors, LP type investors who listen to the show, could you give us maybe, 3 of the top things that you look for in terms of underwriting? What would be your top 3 that you would say?
Yeah, some things that I've seen just recently off the top of my head that would give me some pause if I was a limited partner looking at a prospective opportunity. Pay close attention to rent growth, organic rent growth. I know CoStar and Yardi and some of these national data companies that are deeply involved with multi-housing have some pretty bullish forecasts, and for all purposes, they're probably right on future rent growths, at least short term. But just because CoStar says rents are going up 25% in Austin next year doesn't mean that you should be underwriting that way. So that's one area that I would ask questions on if you're looking at a deal that some sponsor is bringing to you. Just be sure that they're not being overly ambitious with their just organic rent growth. Cap rate, on exit is another big one that can have a big influence on investor returns. If you're buying it at a 4 cap and you're going to exit in 10 years on a 420 cap, that would raise a red flag for me. So be sure that they're conservative in that regard, cap rate expansion. And then just making sure that the deal is well capitalized. How much are they budgeting for their reserve account, for rainy day funds? What's the budget for any intended capital improvements, a lot of deals these days are quote value add, every deal's value add right now, which how can that possibly be? But they all are somehow, and so what's the sponsor budgeting for unit renovations, exterior renovations? Are there any contingency monies, budgeted in? Those things can destroy deals if you're not, well capitalized. So those would be my
absolutely.
probably top
No,
three.
those are some great points, Rob. And also, since we focus a lot on due diligence because investors don't have the time to do that. Another thing that we really look for that kind of dovetails into that is really looking for basically conservative assumptions. So it's really the opposite of that. So the more that the deal can be padded, right, where that rent growth is actually very conservative, right? It's actually underplayed out, and we're looking for those types of assumptions. And then, what I think there is it gives, the operator and the whole team a chance to actually exceed on the deal, right? If you have enough of that, conservatism baked into the deal.
Mm-hmm. Yeah. One other thing I'll add, just for passive investors listening is pay close attention to the rent comp set. If the subject property that we're all investing in was built in 1970, and the 5 comps that they're showing you were all built in 2015, and they're showing you a $700 rent gap. Well, those aren't real comparable apartment complexes. They're much newer, better amenities, et cetera, et cetera. So that's another thing that I'd look for.
Yeah, great point. Great point. So Rob, can you tell us, from a personal perspective, I mean, what has really been, your wealth strategy, right? You talk about trying to help your investors invest like the 1% do. So you clearly must have a bit of a strategy on an investment thesis. Could you share that with us?
Yeah. From a high level, I'm rotating out of, traditional investments, equities, those sorts of things. And I'm going heavy in real estate. I love the tax benefits. I love the cash flow, the appreciation. And I like that they're not as volatile, right? I mean, I like to sleep at night, right? And somebody tweets something, or the Fed chairman opens his mouth and the stock market just flips upside down. It's a roller coaster ride. It's a casino, And so the other piece is, part of our wealth strategy. And I learned this a while ago. I owned a business, prior to my real estate career. And I would network and, different trade associations and things. Well, one of the networking groups I belonged to was called BNI. And their motto was givers gain. And I'll never forget it. Givers gain. You have to give before you can receive. So, my wealth strategy, part of it is to give as much of me as I can to our investors, to our vendors, our partners. And, if I can help enough people achieve their wealth goals, I'm going to ride that train as well. It's only going to help me. So.
Yeah, outstanding philosophy. Very much like the, Zig Ziglar approach, right? And also just serving others first approach, which we share that same philosophy. I think it's really great. And I think, that's why a lot of us are in this business, is to, share the insights and the learnings that took us so many years to uncover. I mean, it's usually like the one thing that I regret is like, I just wish I started this earlier.
Totally.
And it's so rewarding to watch my kids now, to watch my daughter, who's really embraced this. She's already bought her first house. She's actually going this weekend to go buy her second investment property. And
fantastic.
It's really great to see. And then the same thing with investors, once people kind of understand this. And we like to really call it an overall strategy, right? Because it's not just, a lot of people get stuck with, one thing, like we're just in equities, we're just in bonds, and they think that's just, one piece of it, right? But it's really a comprehensive strategy. And I think what you mentioned first, right, around taxes, I mean, people just really underestimate how important that is. Taxes are your absolutely number one biggest expense. So if you're not doing anything to mitigate your taxes, I think you're leaving a lot of money on the table.
That's exactly right. Yeah, tax efficient assets. That's what we look for. And it's not a knock on equities. And I am invested, but the majority of my holdings today and in the future are going to be focused on real assets, tax efficient vehicles, and cash flow producing assets, So,
Yeah.
mhm.
And so from, given that you're focused really on multifamily a lot and real estate, are there any particular markets that you really like or any attributes of particular asset types that you're looking for?
That's a great question. I'll start with the markets. We're in a couple different markets. We really like Indiana, Indianapolis, Fort Wayne, Bloomington, Evansville. Those are all great Midwestern markets. I think there's still some yield there, and we have fantastic relationships. We own property there, and I've been to Indiana too many times to count. And it's just a great place. Diverse job base, et cetera. I think Forbes had an article a couple of years ago calling Indianapolis the Silicon Valley of the Midwest. Headquarters. Salesforce has a big presence there. There's lots of bio firms moving there. So Indiana's one. We like Texas, Houston, Dallas, Austin, San Antonio, but yields have been squeezed there, over the last couple of years.
Yeah.
But we continue to look in those markets and maintain those relationships there. So those are the two off the top of my head. And then the other piece was the asset type. That's an interesting question because
especially right now, right? Where we are in the cycle.
Where we're at in the cycle has shifted our thinking a little bit around things like vintage, when was the deal built, location, and some of these things where historically 70s built, 70s to 80s built apartment communities would trade around, a 6 or a 7 cap. 80s to 90s would trade around a 5 to a 6 cap. And then the A plus core, 2000 or newer built stuff would trade around a 4 to a 5. Well, what we're seeing today is that early 70s built stuff that's getting older every day, like all of us, is trading at, low 4 cap, or I can go buy a 2015 build for like a 390 cap. And my thinking is, and this is what I believe, when there's a correction or some type of, down cycle, the B and C class deals are going to go back to the cap rates they came from. And there won't be that whiplash effect as much in the A class stuff. So, recently we've been paying closer attention to some newer built product, and location, like always, real estate location is everything. But I feel like that's even more the case today. We're at in this kind of late stage of the cycle. Nobody has a crystal ball. Nobody knows when it's going to correct, downturn, whatever you want to call it. But we all know that it is coming, whether that's tomorrow or next year or 5 years from now, that there will be some type of pullback. I bet my farm on it.
Yeah, for sure. And can you share with us kind of what you're thinking in lines of interest rates, right, in the current environment and where that's headed and how that's going to impact your strategy?
Yeah, well, that's how much time do you have? I think short term, Powell has said it, that they're going to raise rates. They're going to raise rates a couple times this year. As far as what that does to cap rates, which historically, interest rates and cap rates of commercial property are, very closely correlated. I think in the short term, if they raise rates, bits and pieces here and there, I don't think short term that's going to have much of an effect on asset pricing and cap rates. That's my personal opinion. I think there's too much liquidity out there. There's too much demand. And unless treasuries move in a material way, I think short term, we're going to continue to see these compressed cap rates. But the other piece to that is rates are going up. They will go up. They're going to continue to go up. And so it's changed our thesis a little bit to where we're looking even harder now at switching over, back towards gold standard debt, agency, Fannie, Freddie, low locked in long-term interest rates, floating rate debt. It scares me a little bit today. And that would be your bridge debt kind of product, right? 3 years plus one, full term interest only, low debt service coverage ratios, on the deals with thin margins. That stuff scares me a little bit in today's environment.
Yeah. Yeah. I think it's also interesting. A lot of people underestimate still just really the economic fundamentals, right, of this whole marketplace in general, right? So, some of the markets that you talked about, and also, we're seeing in the Southeast and the Southwest. We both came back from the IIREC conference recently,
Yep.
and a lot of panelists just, still really highlighting that fact that there's still a huge shortage of housing, right,
Mm-hmm.
across the U.S. And, that need is not going to be, fulfilled quickly. So it's interesting, I think, to keep that in mind, right, in terms of just, the overall fundamentals, in addition to some of these dynamics that are playing out right now in the market.
Totally. Yeah. Yeah. It's interesting times, and there's forces that, are kind of on opposite sides of each other that would suggest, we're going in one direction or the other, because all of what I just said aside, the cost of housing is going up. It's becoming less affordable to purchase, for first time home buyers. And it's creating this inflated pool of renters. So, we're still multi-housing bulls. I'm just being extra cautious in this kind of phase right now with all these moving parts, interest rates, liquidity, everything. So
Yeah. No, absolutely. Rob, I know you're a top performer. So can you tell us a little bit about some of your personal development habits, routines that have really, keep you on track and make you operate at such a high level?
yeah, and Dave, you and I talked about this in Los Angeles at IREC, that balance, right, in personal and business, because as entrepreneurs, we always want to go 1,000 miles an hour with blinders on in one direction, stay in the lane, right? And sometimes it's hard. I'm a family man. I have a wife who works full time, and we have two beautiful children. Our daughter's 6, and our son is 2. And it's hard because sometimes I'm on an investor call till 8 p.m. Or just work never stops, right? But I do have some routines that I do. I swim every morning. I wake up at 4:30. I work out with a group of master swimmers, so it's a coached workout for an hour and a half, and I'm home before the sun's even up. Some days I don't want to go if it's cold outside, but I just grind through it, and it just clears my head mentally, physically, feel great, and it just really sets up my day for being a high producer, and being as productive as I possibly can. Reading, listening. Those are two things I do a lot. I listen to a lot of podcasts. I read, in the evenings, and then really hitting the pause button to have that quality family time, and like I said before, sometimes it's hard, if you got something important that you have to do and it's off hours or whatever, but I really try to make a focus point to be with my family around dinner time. We like to cook together. We like to sit down and eat together and talk about, each other's days and really just reconnect. So
Yeah, that's awesome.
mhm.
Hitting that pause button just seems, so hard living in this day and age, I think for all of us. And, if you don't create some habits to be able to do it, I think you miss that time really to get that much needed rejuvenation. And, you can really actually be stronger at work, and you talk about swimming. Actually, I did master swimming in the past as well when I was training for triathlon. But
Oh yeah.
it's interesting, right? There's a lot of actually parallels to being an entrepreneur or being high performing in business as there are as an athlete. Right. And if
Mhm.
you look at the routines of athletes, right, they're either they're in 3 phases. They're prepping for competition, they're competing, or they're completely resting.
Mhm.
Right. So we should really take those 3 different phases and bring those into our business life. Right. So, you need to take some downtime. Right. And you need to create some triggers to be able to do that.
I'm so glad you said that. I'm a humongous sports fan. I mean, I love it. I love baseball, football. I love, competition. And I've told people in the past, I see a lot of very close parallels between excellence in athletics and excellence in business. You know, all the greatest athletes in the world all had multiple coaches, mentors, the sacrifices made, for those practice and preparation times. I got to skip this event or can't go to that party or, sacrificing some family time. And then just the competition, the gridiron, I love to get out in the business world and just work hard, and it's so funny that there's a lot of parallels between,
Yeah.
great athletes and great business folks.
Yeah, 100%. That's
Yeah.
awesome. So Rob, if you could just give one piece of advice to our listeners, what would it be?
Well, for those that are active in the business or want to get active in the business, it's just really, take action. Don't sit on the sidelines, right? I did that for a couple of years. And like we said before, I wish I would have gotten started earlier, but I was scared. I had the knowledge, from mentors and all my education, but I didn't take action. On the, limited partner side, I would suggest, just getting to know your sponsors, right? And I just finished writing a book, an ebook called the 20-minute per day guide to financial freedom. And it's geared really towards passive investors that are busy and don't necessarily have the time to go get the education, get the experience that it takes for, being an active investor. But the next best thing to take, full advantage of all the wonderful tax and cash flow and appreciation benefits of this product is to be a limited partner in a deal, a couple deals, several deals. And so spending, 20 minutes per day is fully achievable. And a big focus of my ebook is, getting to know the sponsors, right? You gotta trust them. You got to understand their business model, their thesis, how they look at the market holistically, and feel comfortable before you get involved in somebody's deal. So
Yeah, no, that's excellent advice. I mean, taking action is absolutely key. And then, you get to see for yourself, right, the benefits and then how it works. And I think part of this overall strategy, that shouldn't be underestimated as well is, this is also all about taking control. So taking control of your financial future, creating the life that you want to live, lifestyle design, right? And it's a shame because I think the $20 trillion financial services industry, makes us think that we're not smart enough to manage our own money, right? But look, you've been running different businesses. Most of the folks on, who are listeners, very educated, very intelligent folks. So it's just a matter of really, applying yourself, spending some time. And I like that, even just 20 minutes a day, right? But, focus on your wealth, right? Focus on kind of improving, because once you set a target, right, you're going to hit it. If you don't have a target, you're going to miss every time.
that's exactly right. Yep. Yep.
Awesome. Rob, thanks so much for coming on the show today, providing a lot of value to the listeners. Really enjoyed the discussion and look forward to further collaboration.
My pleasure, Dave. Thanks for having me. Let's do it again.
Awesome. Thanks, Rob.